Okay, everybody, there's nothing like making a video for the second time because you forgot to press record the first time. So we're going to look at question A, 18.6. Now I have the majority of it on the board here, so bear with me, and we're just going to kind of do it with it because I don't want to redo it all. So just let's look at the question again. Finance lease versus operating lease. Guaranteed there's going to be a finance lease on the question. Why? Because finance leases are a lot harder. Operating leases, you just take what your lease is, divided by the payments, and you debit, rental expense, credit, cash. We're not doing that. It's too easy. Again. So we've got to determine, is this a finance lease or an operating lease? Okay, so we want to go through our criteria. Is there a bargain purchase option? In this case, there is not. Why? Because if we want to buy it out, we've got to buy it out for $64,000. Okay? Now, again, this is A18.6. We got to figure out. Now we got to go look at the useful life. Is it greater than 75% of the economic life? Now, in this case, it doesn't say if it is or it isn't. So let's just assume it isn't. So then we'll go to criteria 3. What's the present value of the net lease payments? Well, 80,000 times PAD, 4 years, 7%. Okay. Now we go to our table. Okay. That would be 80,000 times 3.62432 equals 289,946. Okay. So notice that goes in here. But first, we got to figure out, is it still a finance lease or an operating lease? And now it doesn't say what the fair market value at the inception of the lease is. So let's just assume it's $300,000. That way we know that equals 97%. So we can say, okay, it's a finance lease. Okay, great. Now let's get into it. So we know it's a finance lease. Okay. Now we got to create our amortization table. Okay. So we start with year one. Our beginning balance, $289,946. Now there's no interest in that first year on our payment on our table. Why? Because we made the payment at the beginning of the year. Okay. So as a result, our lease payment's $80,000. Okay. It's a decrease in the ending balance of $80,000 because there was no interest applied. So your ending balance at the end of year one is $219,946. Now we go to 2002, the beginning of the year. What's the interest expense? $209,946 times 7%, $14,696. Our lease payment is always $80,000. As a result, since our payment's $80,000, the interest expense is $14,696. The difference is $65,304, which reduces our lease liability down to $144,642. We do the same thing for 03. $144,642, which is the ending balance in 2002, becomes the opening balance in 03. $144,642 times 7% is $10,125. Our lease payment is $80. As a result, the decrease in the lease liability balance is going to be $69,875, which reduces our ending balance down to $74,767. Now, lastly, in 04, okay, we are going to make our interest expense $74,767 times 7%, $55,233. And again, that sets up our last journal entry. Now from there, we make our amortization table that will be on the exam. Now we got to make the requirement 2, we got to make the journal entries. Okay. So as you can see here, this is kind of a mess, but just bear with me, okay? I'm just going to go to 01, 2001. Now, the very first entry that we need to make, okay, is debit asset under finance lease, $289,946. Okay, so and then credit lease liability. $289,946. Now, we got to make our first payment. Okay? Well, that's going to be $80,000. Debit lease liability, credit cash. Okay? Now, from there, we make our December 31st entry. Okay, we got to make our interest expense. Debit interest expense. Again, we're always a year ahead, okay, when we're dealing with payments at the beginning of the year. So the interest expense is $14,696. The lease liability gets a credit of $14,696. Okay. This is December 31st though. This is January 1. These are all January 1st. Okay? And then after that, we're looking at December 31st. To set up the inception of the lease is also January 31st. January 1st. Now, from there, we've got to make our depreciation entry. Okay? For 2001. That's always going to be $72,487. How do we get that? $289,946 divided by 4 years. All right, so after we make that first year of entries, everything else, we make the remaining 3 entries, okay, for 2002, 3, and 4. And then that's it, the lease is done. Once the lease is done, okay, we're going to debit accumulated depreciation, asset under finance lease, $289,946, credit asset under finance lease, $289,946, and it's off our books. Okay, so it's been fully recorded, fully depreciated, taken out. Okay, if you can do this style of question, you'll have no problem on the exam. I got through this in about 8 minutes, but I was timing myself when I did the original and doing the original video, and I was up over half an hour. So I don't know if it just took me forever to write everything down or what, but anyways, that's growing pains, I guess. Now, again, if you can do this, you will have no problem on the exam. But just know how to determine, is this a finance lease or an operating lease? Now, sale leaseback arrangements, very similar to this, okay? But if you can do this, you can do the sale and leaseback, no problem. I'm not sure if that's going to be on the exam or not. Now, if you have any questions specific to Chapter 18, please let me know, okay? And I will answer you back either by email or maybe just attach a video. Sometimes, I don't know. I don't mind making the videos. It's just a lot of work. Anyways, have a good weekend, and we will talk to you on Monday.